honored to have very great men and the one and only lady in the panel. And I think for me, today is a very emotive conversation that we need to have. And this resonates with me myself as I build myself from an individual perspective. And today's topic is around safeguarding family wealth and inheritance through tax planning. As we kick off, I think just a few house rules to our viewers. Would kindly ask you to drop your questions on chat and we'll be able to respond. And we're looking to be with you for the next 1 hour, 30 minutes and have a very meaningful conversation. And just before I kick off, I'd like to let our panelists to introduce themselves. And I'll start with the lady in the room.
Thank you, Peter. Good morning, everyone. My name is Regina Mwangi. I am a certified public accountant of Kenya. I have been in the tax space for a little over 10 years, and I'm the tax manager at EBKL. I'm very happy to be here today. The discussion today, I'm really looking forward to it. We've covered a lot in the last 3 sessions leading up to here, from general tax compliance, where we spoke a lot about e-teams, and then we moved to rental income, and then we discussed on oil and gas. And then we're here today discussing on how to safeguard family wealth. So I'm really looking forward to having a very meaningful discussion that will help us, even here in the room, to grow ourselves in a better way.
Oh, thanks. Thanks very much, Regina. And I'll move to my next panelist.
Thank you, Peter. My name is Martin Wawero, CPA, practicing accountant as Nitram Accountants Africa. Our day-to-day is offering tax advisory services, accounting and audit services. We are busy now, trying to ensure that the 2025 years audits are complete. We file tax by 30th of April, and we file tax returns on by 30th June. We still have the hiccups on validating the e-teams income, validation of income and expenses for the year 2025. But we are looking forward towards that seamless filing without challenge. So I'm happy to be here. Yes, Regina has mentioned the journey we have had, quite insightful, and we look forward to today's topic, which is also part of tax compliance and planning.
Great, thanks, Martin. And to the man who speaks of wealth, I'll let you introduce yourself.
Oh, good morning, everyone. My name is Daniel Munywa. I work for the Equity Investment Bank, which is the investment banking arm of the group. Today's discussion is quite personal because wealth must be created, but beyond creation, it must be managed. And families or entrepreneurs have no problem creating wealth. The problem comes in how is that wealth structured for continuity beyond the generation. I work as a general manager in charge of wealth management at the bank.
Okay. Thanks, Daniel. I think just listening to our viewers, experts in very different fields, and it's good to look at, it's so interesting that we are relating tax and inheritance, that we assume a lot of things when you're doing your inheritance plan and also your wealth management aspect. I think for me, one of the things that when you look at across many families today in Kenya, I think one of the stats I saw is that 60% have wills. And I think one thing that makes me happy, this conversation is being held by people who are under 50, let's say 45, if I'm to give the average age. Because I think one of the things as African, the tradition is that we always start inheritance conversation after 50, because you're nearing your end of productivity. But I think to change that narrative, it's a very big opportunity for us to shift that narrative and take charge of how we want to pass wealth across the generation. And I think for me, when I look at it, today, families are generating and creating wealth. And that's not a doubt. And we can see the different sectors and industries that people are able to put food across the table and acquire wealth over time. But when I look at it, when, let's say, Peter, who's built a multi-billion-dollar company, I'm out, let's say, my time on this world is over, and then the next thing is, of course, I have to hand it over to the next. You find either the transition or the management of that wealth either ends up crumbling, but if you've put the right structures in place, you'll see us successful. So I think for me today, I want us to dive straight into the key conversation. And one thing that makes me very proud about Kenyans is we are resilient, very innovative, very entrepreneurial. And one of the things that I've always known for me, I think most people confuse next of kin. You see, when you come to the bank, they'll always ask you next of kin. Then you think, with that, I'll assume, oh, I've already transferred my wealth to the next of kin, either my wife, my kids, or whoever I'll put as the person who will actually take up the wealth.
Sure.
But I think for me, I just want to start off with you, Dan. Could you help me understand? We discuss wealth, rich, money. What is wealth? And what are the instruments that we can leverage on to be able to do succession planning, and also and which applies when and where?
Good question.
Yeah.
First, a very interesting one, because is there a difference between money and wealth? And from a base of it is that money is what we earn, is what flows in and flows out.
Yeah.
But money is generated through wealth. That the asset that brings the cash flow, the inflows, the outflows, is a tool for wealth, or it's wealth. So money is what do I have now, what is coming in, how I spend it. But the next step comes that, is it possible to have money and not be wealthy? It is. Because after earning money, what you do with that money is what determines whether you'll be wealthy or not. So money is a tool to become wealthy. So in short, if you have an asset, let's say like a rental property, or let's say an asset like a treasury bond, that is a house of wealth that brings in money. So the distinction is between money and wealth. Between one is sustainable over long term. Money is what comes in, but it may create wealth or not create wealth.
Interesting.
So in this discussion about, we have no problem. The families, entrepreneurs who are listening to us have no problem creating wealth and having that money and even that wealth. But often, at times, as we interact with you people, we find there are questions that families are asking. Because wealth can make a family comes to a crossroad. And questions they're asking of us is it possible that we can have these assets, this wealth, and still be broke? And they're also asking, do we need to plan our retirement or the retirement planning around what we know, around the properties? Is there a way we need to diversify this wealth? They're also asking questions on how do we mainstream the second-year generation into the business decision-making, so that the issue is not just distributing wealth.
Yeah.
The issue is teaching values that have created this wealth to the children. Others are asking, should inheritance, which is part of wealth distribution, be done after I'm gone? Or should I empower and seed into my generation when I'm still alive? At what point do I give control and decision-making? So all these questions are coming to families, and because they have made wealth. But how a wealth is structured is what determines whether you are going to distribute it or you are going to ensure it goes on for continuity. So coming to the instrument that families can use, we know the common one, the will. The will is also a legal document that illustrates who gets what. it is a tool to distribute assets. And a will come into action when the founder has passed on. It does not come alive until the founder has passed on.
The creator.
The creator of that wealth or the creator of that will. So the wealth, the will is used to distribute asset. Who gets what and how much? And there comes one of the big challenges because it means this wealth that has been created is being distributed
It's basically moving one from the other.
to the other. And the danger is if the wealth where it's moving, the person has not been mainstreamed into the decision making when the creator was alive, that I am going to give you this business, or you get this 30% share of this business. It's also an avenue where the most businesses and most wealth collapse. So a will is important to give your intention of clarity.
Okay.
Clarity on how you want your wealth to be distributed. But we know also there's also a danger of distributing wealth. It can also mean the head of the wealth. Because now you have different parties that are managing wealth through their own decision models. But then there are also other families or other businesses that decide, apart from determining who gets what, how do we ensure that there's continuity of this wealth? How do we not give ownership, but we just give decision-making control? So they form a trust. So a trust is a legal structure that ensures wealth continuity. It ensures that there's the one who is forming it, first he forms it not to distribute wealth, but to create an avenue where decisions around wealth are incubated when he's alive. And when he leaves, he knows that he has left that wealth in a structured environment. So trust or structures, which have become very common. The only challenge is that we have seen people are putting up structure towards the tail end of their lifetime. But here, let's say, assume over 70 years and above. And because they have not built the culture of including their children or their family or into the decision-making models, sometimes the danger is that they appoint different parties, external parties, to become the trustee and the executors of it. But coming back to your question is that a will is who gets what. It does not guarantee continuity of the family wealth. But a trust now becomes a structure where now even the creator of that trust assumes even 100% ownership when he's alive. But he can decide, when I am gone, this is how the distribution becomes in terms of structure. So a very important way to preserve wealth, because you have full control when you're alive, and when you're not there, you almost bring in an aspect of a will within the structure to say who gets what. Back to you.
Thanks. And just listening to you and looking at, before I joined financial services, most of the conversation and tradition for our Kenyan community is, and actually African, it's normally a will. That's the standard best practice. And listening to you, it presents a very big opportunity for people to understand what exactly does a trust mean. It just, because listening to you, most people would interpret a trust, you're handing over the wealth to be managed by someone else, and you're not in control. And that brings me next to the next question, and I think Martin coming up. When you think about wills and trusts, where do we find tax efficiencies? Because for me, when I think about, in a very layman's understanding, a will, my father wrote it and wealth was transferred to me, and there's the implications. But just thinking about it practically, between the two, where do we find the tax efficiencies? And you can walk us through what tax implications mean from a will perspective and as well as from a trust perspective.
Hey, Peter, a big question, but when Dan was trying to take us the introductory bit, what was coming to my mind is where does this wealth come from? Where does this wealth come from? 80%, if not 90%, of the Kenyan businesses, enterprises, are majorly family-owned businesses in form of limited companies, partnerships, or sole proprietors. So the transfer or the creation of wealth originated from a business enterprise, from an incorporated aspect of a company.
Okay.
Where maybe the let's say the man started up a business, and the business ran, and maybe and in the company's perspective of management, we always talk of a business as a going concern. And in the management of the businesses, and we have seen, they come to be the shareholders and managing directors, or who you may call the CEO. Therein, they introduce other people in the management to continue managing the business, to expand it. Now, the wealth is created after what we call a balance of income, profits, distributable profits from the business that we were running. And for that reason, then this business must have accounted for its full income, expenses, and the balance of it is then distributed to the shareholders as dividends. Now, who are the shareholders in that company? If this promoter or the original creator of the company, as the shareholder receives bonus or the dividends, can instruct the company to transfer the portion to that, either what Dan has mentioned, of the registered trusts. Remember, before the transfer, before the payment of dividends, we have already paid tax. So what we are saying we are safeguarding or protecting is further taxation of
the
income that was already taxed. So it then means that all the taxes have already been deducted and remitted to the authorities. Now, further distribution, further creation of now that money is where now that portion of dividends is where then Dan comes in and advises how can we make this money invested to earn more income over and above the running business. So what we are saying is protecting of this money from further taxation is where has it been invested. And as such, there is the deductible legitimate taxes, expenses that are subject to that income. And now the distribution of this surplus to the beneficiaries is now also the element of tax planning. Yes.
Interesting. Tax. Everyone hears the name tax. Ushuru, kulipa ushuru ni kujitegemea.
Yes.
And it's quite interesting because how wealth moves from transfer from one individual to another and the implications of tax, just listening to you. So just let's look at the aspect of I have an estate, right?
Yes.
And with my two children, I want to split it between the two of them. traditions, a typical African, our typical African behavior is to distribute it equally amongst your children. When you think about it, what are the tax considerations that I should be aware of when planning for this wealth transfer? Because when you think about it, for me, I'm doing it in the name of, I have a block of apartments, they are 24, so each of my son will get 12, 12. So what are the considerations that you'd put into place from that front?
Interesting. Dan has mentioned about the will. Will states clearly and gives clarity as to who gets what. How about in the instances where we don't have equal distribution? You are talking of one apartment, one block, and you have three beneficiaries. How do you distribute to the three? So it is in the wisdom of the owner to create a trust and say that this unit is owned by the trust, but you are the beneficiaries. Meaning there is no specific individual who owns it. That trust is what you may call a body corporate.
Okay.
It is it is what you may say is a registered trust, which can own the asset. And so income now generated out of that, the good example is that of the rental income.
Yeah.
The generated income out of, say, the rental income, it will be subject to legitimate expenses towards the generation of that rental income. For example, you have given that property to management agents.
Yeah.
They will charge you the management fees. You have transacted with a lawyer, you'll charge. There is a caretaker, they will charge. Those are what we call legitimate business expenses towards the generation of that rental income.
True.
The balance of that is what now is distributable to the beneficiaries. So the primary taxes must be accounted for. And the very first beginning of this series, Regina has always been mentioning documentation.
Documentation,
very important.
Yeah.
So we must, and in this day and age, we must always ensure that ITIM's valid expenses or receipts are provided. So it is on that point of where is this registered. Now the property, in which form it is registered, and what taxes are then applicable. So on the distribution, there's also a difference between legitimate expenses into that business or from that income generation. And there's also a difference between distribution to the beneficiaries.
Yes.
It is now subject to what is it that they have earned that then they can be taxed at their individual levels. Remember, if a trust is registered, it can be taxed as a single unit. Compared to the distribution, now you tax at the individual level, which is a saving. Yes.
Yes. And to his point, let me just add. To his point, I think the discussion now is evolving into, and it is the question of what is fairness? How does fairness look like to the creator of wealth? And he gave an example of this family has one good asset, let's say in a very high-end area, and other assets are distributed across different parts of the city. So from the founder perspective is, how do I look fair? The question of fairness towards the beneficiary. Who gets what? And the and the founder gets stuck because if you don't address the question of fairness, even if you go ahead and include it in the will on your distribution, that will be contested. And that's the beginning of a fracture of wealth. Because the question of fairness was not addressed by the founder when he was doing the will. And that's what you said about the trust. When there is indivisibility of prime assets or of assets, then a trust becomes the vehicle where you're able to give everyone an equal share. But also, even we go further, is that is it the right approach to distribute wealth? Because the danger of distribution is that it's distributed to different parties who may not have been part of the wealth creation, or who may not have been mainstreamed into how this wealth has been created.
And you're actually creating fragmentation.
Fragmentation
of
intentionally. And of course, it's like the family is going on their way. I'm not saying that the founder should not seed, because also there's no point of waiting for death for children to come and access your asset. You have seen families where the founder is very wealthy, but the other sons are struggling, or daughters are struggling. And yet they are raising his or her grandchildren. So it beats the purpose of wealth, because wealth should provide dignity and raise the pedigree of the family from one generation to the other. So the question then becomes, should we think through the will? Will, of course, gives clarity and avoids the legal dramas that come without it. But the question becomes, how do families don't take it as wealth distribution now anymore? They look at it purely from the eyes of wealth continuity.
Yes.
Yeah.
Because every founder aspires that wealth succeeds him. But distribution becomes a part where wealth is fragmented.
Okay, interesting. So listening to you, it sounds like basically a will. So will they operate in, do they both operate at the same time? So for example, can I have a will and a trust? And I think for us, it's important to, for even our viewers to understand how will the two operate, or do, and listening to you, a trust seems to be more effective tool of wealth preservation, and even from, and it's more of seeding, what I'd say, control, not ownership.
Yes.
Where it's driven by experts and you have the whole wealth consolidated, not in a fragmented way. So just listening to you, back to what I've just asked, do the two operate at the same time, or how effective can one be when you're doing your journey on inheritance?
Good question. In fact, we start from between a will and a trust.
Yeah.
The first step for any family, which is basic, as a basic step to protect wealth in case of their demise, is to have a will. It's the basic way of preserving wealth, not preserving wealth, of protecting wealth, because we know disputes, they eat wealth, they cannibalize wealth. So a will is an intention that I want to do 1, 2, 3. When you come to a trust structure, which now is a body corporate,
Yep.
there are trust structures where the founder can decide what percentage goes to the beneficiary. He can even decide, as long as he's alive, he maintains control of the whole trust. But in the course of living, as he pushes on with life, he will see this beneficiary here. I had allocated him 25%. Can I change? That he can be able to do as long as he's alive. But to give force to the structure, because the structure also is alive and the shareholding keeps on changing as the founder analyzes the beneficiary. At the end of it, the will should be present, because his final will, it may not supersede the structure, but it gives life and credence that whatever Mzee had put in the structure, no one complained when he was alive. And this is all what is replicated in his will. There are some also other assets. He does wealth. He does not need to transfer it to the structure because they can be easily be distributed. Things like cash.
Yeah.
Cash is divisible.
Divisible, yeah.
There are some prime assets which needs to go there. There are some small assets like plots. They may say, I'm going to give you on this, and this, which can be done through a will. So a will, as trust, does not exclude a presence of a will. There are some assets that don't need to be in the structure that are purely given on the will. And in fact, he might find what he wants to be continuity. If I have a big skyscraper in CBD, that one I may move it to a structure.
To a structure.
But there are the other smaller assets across the city or in the country that I need to give my intention. Because I know a structure, they may not have full control. But I have a will that allocates these smaller assets. And that's why I was saying a will and a trust can live at the same space.
Sure.
Oh, yeah, I'm also learning, by the way. And thanks, Dan, for that, because I think it also enables us to understand how to transfer the wealth and the difference between the will and the trust and how the two come into play. I think, Martin, you highlighted, and I'm coming back to you. When you think about tax, how are the different assets treated? And I know you spoke about it high level, but I'd like us to drill a bit deeper to just understand, let's say, property, how is it treated from a tax perspective? Because I think he's spoken about you writing a will and there's a cash element which is very divisible, but now you have the physical assets that remain. How are they treated? Talk about property, talk about shares, talk about the business income that is coming in. How do we treat the different key aspects within the wealth space?
Actually, the main tax issue here is, and because we are talking of Regina, we are talking of the immovable assets. We are more of like capital gains tax.
Tax, yes.
On the transfer. But then, moving the property in my name to my trusts, that is not, again, it does not attract tax element.
Okay.
Because transfer of an asset internally does not constitute a transfer to a third party.
Okay.
And for that reason, there is no tax element. So, but in the event, even the property so transferred into the body corporate code trust sells, the trust now sells that asset to a third party, the capital gains tax comes in. Now, maybe the person selling this property are the beneficiaries of the trust. So, and maybe it's a long time, is a historical asset, which maybe at the time of acquiring, compared to the date of selling, is not comparable. For example, maybe they bought it, or the Mzee bought it at around 10,000 Kenya shillings. And it has been there for the last like 20, 30 years. Upon his passing on, the market value of that property today is like hundreds of millions, depending on where it is. So by the time it's being transferred, then there's need to do the valuation of that property, which then gives the indicative market price.
Okay.
And that would be the revalued property value, which then would inform the selling price.
The selling price, okay.
Then all legitimate expenses towards now the sale of this property, like the valuation, like the legal fees, and all that, is when then you determine the gain or loss on the sale of this property to a third party, and hence then you calculate the capital gains tax at 15%.
15%.
Any other income would be taxed at source.
Okay.
talk of treasury bills,
Treasury bills.
talk of dividends, all that, depending on where they are, they
Coming-
are,
the income
and
is
to
coming
who they are distributed. Yes.
Okay, great. Regina, just
Yeah. So I just want to emphasize on what Martin has spoken about on the whatever is being transferred into the trust is exempt from CGT at 15%. So previously it was at 5%, but it rose to 15%, which is a very big amount to be paying out to KRA. So there's a saving that you do if you have that transfer into the trust, and also to the beneficiary is also exempt from CGT. So that's what Martin is mentioning. Now, after the beneficiary receives the asset and now wants to transfer it, then there's need for the valuation and now computation of CGT and payment of the same. And there's also stamp duty.
Yes.
Stamp duty applies on shares. So if you have the trust and you're moving your shares into the trust, then again stamp duty is exempt. The movement of the shares from the trust to the beneficiaries is exempt from stamp duty.
okay.
Now, once it moves out completely from the trust, is when now stamp duty will apply again. So there's a tax efficiency in moving your assets to protect them in the trust. Yeah.
Okay, great. And actually, I was coming actually to you to discuss about efficiencies. I know we've understood how the trust plays and how the will plays within that. We've understood how the different elements in terms of income, property, the tax comes into play. I think for me, the other thing that we also need to discuss, and you've kind of highlighted slightly, is around the efficiencies. How do I drive efficiencies within the tax, within the trust? And currently, I know you've talked about over saving from a percentage perspective. I know it's not avoiding tax; it's a
No,
saving.
it's a saving.
And being efficient.
Yes.
Probably just take us through what are the effective strategies that we can use to minimize the tax exposures when you're transferring wealth in that manner.
All right. So I think we'd had this conversation before on when you get an inheritance or when you get a transfer, sometimes you think automatically this is it. Zay has said Peter will receive this 1 acre of land, and you think, okay, fine, that's enough. But there's the next step of transferring this asset to you. Ideally, if Mzee was to do this when he was alive, then the CGT and the CGT would be applicable because you're transferring from one party to the next.
Yeah.
And that's why the trust comes in, and it's good because that CGT that would have been applicable is no longer applicable because now you're in the trust setting. So the 15% that you'd have paid after doing the adjustment and computing the gain is not applicable in the trust setting. And it's also not applicable when eventually this parcel of land is moved from the trust's name to Peter's name.
Okay.
Okay?
So it's now under an individual.
Yes, now when
Yes.
you move it from the trust
To an
you,
individual,
it's
yeah.
still not. So the tax will kick in now next when Peter wants to sell it now to a third party, as Martin was mentioning. Yes.
Okay. And I think everyone is looking at, I was having an offline conversation with Martin, and he mentioned that tax can follow you all the way to the grave. and I thought that was a very powerful statement. I think for me, the other thing is thinking about tax efficiencies. What are the tools when you think about the trust, the wills, and business structure? How can they support this process of transferring wealth to the generation?
Okay. Tax efficiency comes in because you don't get to pay Caesar more than what he's supposed to get.
Yeah.
And to protect this wealth, then these tax incentives have been put in place just to ensure that the wealth is not depreciating as it's passing down. And I know this conversation of trust is really coming up. I've seen it quite a number of times on socials. And Kenyans are becoming more and more aware of the tools they have to be able to be more tax efficient, to have tax avoidance as opposed to evasion. And these are tools that Kenyans need to know more about and invest more in. And I believe now, like Dan here and the role he plays within the bank supports with that.
Wow. And to our viewers, I just hope you're dropping your questions as you follow through. I think it's very, I'm also getting to learn a lot through this gentleman and the lady in the room. I think for me, I just want to come back. You've made wealth.
Yes, sir.
Yeah. And one of the things that we are always told, and it has been never put your eggs in one basket. If you do it practically and you trip, they're all gone. When you're doing wealth transfer, how do we help? What role does diversification come to play? And how does it support the process of ensuring, securing the wealth for the future?
Good question. This trust and wills, which are one of the tools to wealth preservation. We have said a founder of the enterprise of wealth wants the wealth to succeed him. And he can choose it to succeed him through his beneficiaries directly or through a family lineage. That's what the trust comes into place. But a trust will not, or a will not solve the challenges of how that wealth is structured. And I want to differentiate between trust and structure. We have said that families are, every day they are building wealth. They are putting up new apartments, they are putting up, they are buying land, they are building wealth. But the question is, this wealth, how is it structured? In which format is it in? When we began the session, we said, first, is it possible to be wealthy but broke? Such that you have accumulated a lot of vacant plots. So it means if you are to transfer that wealth, you are transferring problems. You are transferring illiquidity. So then the question becomes, then how do we make wealth transferable ready? In which structure should wealth come to place? And that's where diversification comes in to resolve that problem of over-concentrating all your wealth into one side.
Yeah.
We have seen families struggle with medical bills, yet owning tracts of land. So even if the founder transfers that land to a structure, to a trust, he transfers the same constraint, the same challenges he has faced through his life to another generation. Yet he's the one who is on the steering wheel. So our challenge to families is to look at their wealth. Is it leaning on one side? Some, of course, have also put up rental properties. And yet we know there are constraints that come with rental income, from tenancy, level of occupancy, taxation element. So if you find a family that has leaned toward rental property, even when they come to the point of either transferring through a will or into a trust, they were still going to transfer, if it's the same inefficiency, the same way. Other families, I have said, have brought a lot of plots, which are vacant. It has increased their net value.
Yeah.
You remember the families that have kept files of titles in their cabinets, and yet they are unable to pay the best medical care in the US, yet their wealth can afford. And as we know that wealth should provide dignity. It is not for accumulation.
It's dignity.
It's dignity, freedom, and stability in a family. So how you diversify your wealth as a family matters a lot. And we know that most of the African families, including us Kenyans, we invest most of our wealth in properties and also in our children, through education. Because traditionally, children becomes our guarantor.
Black tax.
That black tax. But I don't think it will apply in the coming generation. But you find most of our wealth is very illiquid. Those who have built up apartments, they are better off. A little bit, they have some income. But if you look at their form of wealth, then you realize the returns keeps on going lower. Every time. A depreciation of an asset means a lower yield or a lower rent. So a family leaning on rental property alone also is exposed. A family leaning on plots alone has no cash flow. They are transferring net worth, but not dignity, because income brings dignity to a living. And then you find there are also other families which are saying, hey, I think we also need to have a portion of our wealth in financial assets. There are those physical assets you have. We put up an apartment. You go and put up, you buy 10 acres. Your net worth is very high, but we know that the quality of your life is not dependent on your net worth. It's how much you're earning. Then you find another family is saying, can I also buy a financial asset? And the financial asset is, I know most families have begun buying things like treasury bonds.
Yep.
And just to give you a context, in the last 4 years alone, so that you can see how family composition is evolving. Families had invested 200 billion by 2022
Wow.
in treasury bonds at central bank.
200
Billion.
billion. Wow.
3.5 years later, we have hit 1 trillion. What does it show? There's an evolving trend that even those guys who are given properties through a will are disposing them. And they are deciding to structure their wealth not generally purely on physical wealth, physical assets. They have decided let us diversify. Let us go and buy an infrastructure bond giving 14%. Because we know when we build up a rental property, it is between 8 years and 16 years. I mean, to recoup your money with a return of 8% gross.
Yeah.
So families are coming to the table and saying, then why don't we build a financial property? Not made of concrete or sand. But this financial property, for the next 18 years, is going to give us 14%.
Yeah.
Wow.
So families are deciding then, instead of me putting up the next property, or instead of me having these 6 rental properties, can I sell one, make it soft, buy into an infrastructure bond? This rental property is giving me 8% when I've assumed 100% tenants occupancy. And before the tax people here come and takes their 10% or 7.5 or whichever. But this one is saying I'm getting this 14%,
14%,
and it's tax-free. So if a family does not reinterrogate how their wealth is structured, not how they are creating it, that one they are the drivers, how they have formed this wealth.
It's structured.
Even now when you transfer it into a structure, you transfer Mashida. The same challenges you faced, you transfer it into a structure. So it's a wake-up call for families, even as they decide we are going to this direction of the structure, first to see how is our wealth structured. And since I'm still making wealth as a founder, the business is still generating wealth, how do we want to organize our wealth portfolio? So that even as we transfer it to whichever form, whether through a structure or whether through a distribution, the founder burden being at the steering wheel is to ensure it's being transferred in the right form. That's why we look at wealth creation, wealth structuring, which is now diversification, and then through which tools, legal tools. And then now we have the wills and the trust. Where now the discussion now comes to how do we ensure which assets brings more tax efficiency, and that now becomes part of the discussion.
Okay, interesting. I think for me, the other piece, and just listening to you, is the decisions we make have an implication.
Yes.
So probably my father left me a block of apartments. I'm earning 8%, but the taxman is coming for 16%. You've mentioned about if I move into financial and digital assets, to talk about of your bid bonds, it's tax-free, which you're earning close to what right now? 14 to between 14 and 18%, giving that tax-free. And I think Martin here, just help us. What are the common things that you're seeing and the common problems which you see every day when families come for advice to your firm? What are the common things that you're seeing?
I think we need Dan to journey with some of business people, because the reality on the ground is very different from where I sit. Majority are in the space of, I have this company and it has employees. I earn a salary as a director. I do the drawings as a director. The company is VAT registered, it charges VAT and such. And very few SMEs declare dividends in their whatevers. They take it in form of salaries. You'll find most of the business owners who are mostly the managing director and they are in the management space, they are in salaries, which becomes an allowable deduction in the books of that company. Now, remember, wealth creation is what we call disposable income. You invest your disposable income out of, so when you earn a salary, you deduct your living expenses. The disposable income, the balance of that is what you say, let me invest in this. Treasury bonds, you invest in shares in particular companies. And now the returns on that is what now builds over time. And remember, you can also, this property, you may not have inherited a property. So you may have acquired a loan to acquire that property. You may have acquired a facility to put up the structure that Dan is talking about, which will earn the rental income. So trusts are not formed to evade tax.
We must pay our taxes.
The form in which the business, because remember, we are in business setup. So whichever the business form it is, whatever business activity you are undertaking, and all applicable taxes must be complied with.
Simple as that.
Simple as that.
Interesting.
The disposable income, where it has been invested, is what we are seeing. Is it subject to further taxation? It is on that basis that then Dan is saying, can we diversify? Yes.
Are there instances you've seen double taxation, yet it could have been avoided?
Exactly.
Yeah.
So it is in that wisdom that you come to us, you go to Dan, and he tells you, look, the balance of your salary, you can invest in this. Because now that is, whatever you are seeking to invest is what you are calling the disposable income. So to avoid future taxation, what options, to avoid double taxation, what options do you have?
Do we have?
Yes.
Okay.
But then, what you may invest, that is capital. And capital
Attracts
may generate now income.
income.
That income would be subject to taxation. But what also are the applicable rates on such?
Okay.
Yes.
Okay, interesting. I think that double taxation of it speaks to how our understanding of the different roles, how the income revenue streams in, and how to be efficient, not to avoid tax. I think I'm choosing my words very carefully. How to be efficient with tax.
Yes.
Because I think that's a way of also ensuring that you're avoiding things like double taxation, as what Martin has just spoken into. And when you think about that, you find 8, actually, the number is 8 out of 10 Kenyans have not documented their wealth transfer. And I don't know, here I'll come back to you, Dan. I'll probably start with Regina here. What are the risks that you're seeing of informal and undocumented wealth transfer? I know, we know the wrangles, all that, but I think also think about it from what it means from implication from a tax perspective that you see? And I think, Dan, I'd also like to hear that angle of what's the journey? When do you start? Do I wait until I'm 50 for me to start? Like today, I probably have, I know from where I come from, we are big on land. I have 10 acres, but they've just been lying there. Probably right now is when I'm thinking about agriculture and all that. So I think for me, I'd like to first hear from Regina on that aspect. Then we come to you to understand when do we start.
Okay.
Yeah.
All right, thank you, Peter. I think I'll come back to what I've been saying the whole series.
Journey, yeah.
Yeah, on keeping proper documentation. You see, unlike in a court of law where you're innocent until proven guilty, when it comes to the revenue authority, the assessment stands until you can prove it otherwise. The burden of proof lies on the taxpayer. So even if there is the transfer, then the due process has to be followed. If there are any taxes to be paid, then anything has to be done properly and documentation kept properly to avoid the instances where you're being asked to provide documentation to support that certain processes were followed and that is not present. In the absence of that, then KRA's assessment will always carry the day. Yeah. So it is important that even as the trust is being formed, the due process is followed. Documentation, transfer is being done, due process is followed, and proper documentation kept. Just to avoid any instances where things are not clear, nobody knows where anything is, and you end up paying taxes, yet we could have avoided that by having proper documentation. Yeah.
Interesting. Yes, Martin.
Maybe to add on that and to ride on that. Huh?
Yeah.
You know, we are talking as the men. As the creators.
We're the culprits, yeah.
Yes. So, where is the genesis of this? I said it's in the SME company, the company that he started as maybe husband and wife, or even him and other colleagues. They became shareholders and the directors in that company. Now, in the event that maybe with age and all that, them they now incorporates a trust, this trust can be introduced to own the shares. So Mzee can transfer the shares, his personal shares,
Yeah.
To the trust.
to the trust. And so the trust becomes a shareholder as a body corporate in the company which is still running the normal business. Yes. So we are looking at a situation whereby, number one, there is a business that is a going concern, and who are the shareholders, and what is attributable to shareholders is not the individual trustee, but the body corporate. So upon the distribution of dividends in a company, even if not, we have even seen even publicly listed companies, shares held by trusts. So these trusts are individual trusts.
Yeah.
Incorporated.
Incorporated.
So they have the right of owning shares in particular, and this is now what we are saying, that upon distribution of dividends by that publicly listed company, the dividend will be the dividend on tax. The tax on dividends will be final tax, and upon arriving into the trusts and distribution to the beneficiaries will not be further taxed. But then we also need to look at what are we talking about, what expenses are covered in the trusts. Because we said beneficiaries of a trust can be minors, people below the age of 18 years. So, number one, medical bills, education, and maybe maintenance. These are not really expenses of the trust. These are distribution to the beneficiaries. So it's good that, as Dan was saying about the structure in which the wealth is managed to be now to be professionally managed, because then we'll be able to differentiate what are legit expenses
Yeah.
and what are distributions. Yes.
Interesting. But I think back to our views, I hope you're still following through. I think for me, the key one is keep your questions coming in. And I think just listening to these wonderful people here with me is that the reality is that building wealth is just half the journey. Because you've built the wealth is here, that's half the journey. Where the work starts is actually protecting it, structuring it, ensuring a smooth transition from one generation to the other. And that brings me now to Dan. When should we start? I remember, and I want to give a story. And this is more of from a personal experience. Every time I go to, there's a shop in town. It's run by an Indian friend of mine. Every time I go, he's now in his late 60s, 70s. But 10 years ago, I was still young then. I used to pass by their shop then with my parents. So what I learned is that every time I'd go there, the son, who was then, I think, 18 then, clearly was always in the business. And there's something that I got to learn is that it doesn't start from a point of, I'm exiting, here's the wealth. It starts from growing and nurturing the young kids. So I think, Dan, just take us through, when does it start? When does this succession process start?
That's a very good illustration you have given. Succession justice in the corporate world is a live process that starts with, if this manager is to go, who can take over?
Yeah.
It is to anticipate that there will be an eventuality that we may not have control when an employee is leaving or when a life is lost. And yet this life or this employee is a decision maker. So at the beginning, so that we don't make this one looks apocalyptic, or I'm doing this because something will happen to me. The founder or the business creator or the wealth creator must look at this first from the comfort of, I'm doing this to ensure that there's a wealth continuity, not from a wealth distribution. Like right now I have a chance when I'm alive to structure how this wealth can be transferred. At least I have control. So the first step is from the mindset, or what we call a mind shift. A mind shift from seeing this as a precursor, or as if I start doing this, then it means I'm also starting to call on my exit. So what families have begun doing, and particularly those who are in business, leave alone those who are managing wealth that is coming from the business, they are mainstreaming very early the decision makers who are the next generation. We have seen families that have brought their own 16-year-old children in high school holidays to participate and understand what we do and why we do it as a family. So a founder, if they have a chance of having a young family, of having young children, or even those who have adult children, the first step is to see it as, I'm restraining them, not so that I can lose control, but so that first I can also induct them. Because there's no point of transferring wealth. You transfer values, the values that have built these enterprises. That's what ensures continuity. And then they build on them. So that becomes the first mind shift or mindset that the founder comes to. If it's about to transfer of us business or the family wealth, a founder may start getting entangled emotionally. We usually say that after the age of 57, the founder, or whether the patriarch is there or the matriarch is the one who is there, start getting entangled with the next generation, such that they are unable to determine that I will have worked all my lifetime to build this wealth. by the time when they start thinking about retirement planning, which is an aspect of wealth management, they get entangled on all these assets I have. If I start selling one asset to do what Equity is telling me to do from wealth management, am I not reducing the inheritance? Very emotional conversation. And of course, the second step is for the patriarch or the matriarch to determine what belongs to me, me and my spouse, and what belongs to them, the beneficiary, so that they're able to be entangled to say what should go into a trust is maybe whatever belongs to them, or what should remain in a will is whatever is mine and my spouse. So that distinction of saying ni gani yangu and what is theirs is a first step. Number 3 is to look at, let me do an audit of how much I have. A moment of recognizing I have 50 acres, I have 50 million, I have some 3 businesses in different sectors. This is where you need now an advisor, a wealth advisor, to come and say, this is how your wealth is structured. This is how it sits. And the discussion starts there. First, is this the right form of how your wealth should sit? We know the business are going on well, but are they catered that in case of an exit, there's no collapse of the business? But then we come to the main thing. This is how your family wealth sits. And we start conversation, and the bank has offered wealth advisory services, where you can go to the branch and ask for a wealth advisor. And the request comes to the wealth specialist at the investment bank. The bank has facilitated that families can start this conversation straight by going to the branch manager and asking, can I see a wealth advisor? Because I need to look at how my wealth is seated, so that even I make a decision on which route to use, whether through a will or through a trust. I want to have a basic understanding. I want to make my wealth ready for transfer. Or for formulating into a trust structure. So in summary is that mind shift of knowing, me starting thinking about this is not thinking about my mortality, my death. It is thinking about continuity. That mind shift is important. And then you walk to the branch, ask for a wealth advisor, and then you have a conversation of where does your wealth sit now? Is your wealth portfolio intelligently designed, even for transfer?
Interesting. And you've mentioned something, and probably I'll have Martin speak on this. Audit.
Yes.
When you think about audit, we always think about it from a business perspective, from an organization perspective.
Yes.
It's a very big word.
Yes.
But for me as an individual, there is no day I'll ever think of a stop and think where I'm doing an audit of what I entail. And with audit, it brings in the aspect of risk and compliance, because once you understand where you are, you're able to know how to navigate. So I think I want to hear you, Martin, and probably you can speak of examples. Are there clients you're walking them through that journey of audit, where they're able to understand this is the size and what does that process entail? And also identifying the risks that are within the land. Probably the land is in, God forbid, riparian land, or I've invested in something as risky as a boat, and then storms come. So I think I just want to hear from you, how you're going through the audit process for individuals.
Thank you, Peter. And what has come to my mind when he has mentioned of audit, you know, audit is a technical term, but in simple language, from a layman understanding, is do a stock take. Precisely that, because when we then look into it from an audit perspective, many will think about financials audit, and then the tax issue comes in. Simply do a stock take. How many assets do I have? And as you mentioned about the risk, is what is it that I'm supposed to comply with in the ownership of this particular asset? For example, if we start from as an individual or as a trust registered, is it today we are aware that registration of trusts has moved the process all the way to the BRS, Business Registration Services, where we used to call of Sharia House. Now, you have to do the trust deed and be registered with the Ministry of Lands.
Lands, yeah.
Then it needs to be incorporated and registered with Registrar of Business Services under trusts. Now, that is one form of audit. Has it complied with and with all the beneficiaries or trustees
Yeah.
well identified and presented for registration? That's number one. Number two, what are the rights of these trusts? Number one, to own assets. So when you now go to own the asset, for example, if it's to buy shares in a publicly listed company, how do you buy those stocks? Is it through a broker? Do you have does the trusts have the bank account and all that? And as such, it is eligible to buy because it will have money. That money sits into a bank. Up to the point of transfer and having owned by the trust by having all the compliances and having conducted the proper due diligence before committing. Maybe Regina.
Correct.
Yeah.
Well, and also apart from now just ensuring that whatever you own is duly owned by the trust, proper books have to be kept by the trust. Remember, once it's incorporated, then it's a company. It's a trust, but it has to be registered with KRA, has to get a PIN as well. So at the end of the day, the trust still needs to file returns, pay whatever taxes are due.
Okay.
Yeah. So the audit still continues even to the trust level, in the sense that it has to be clear on what incomes are coming in, has to be clear on the obligation that it has with KRA, and to pay whatever taxes are due and to file returns when they fall due.
Okay. Interesting. And probably, Martin, as you come up, actually, we've spoken about this trust conversation. How do you set up a trust? And I think it's important to also unpack. We've talked about trustees and beneficiaries, how the role, the two interplay when it comes to a trust. Probably you could start with setting up and how that the two come to interplay between a trustee and a beneficiary. And probably, Dan, you could chime in on that as well.
You know, what you're looking for is the legal formality of having an incorporated, what we call a body corporate. More or less the process of when you are, you have decided to create or to incorporate a company. A company is governed by what you call memorandum and articles of association. For a trust, have to have what you call a trust deed, which then spells out the mission for which, or the objectives for which the trust is to be established for. So, and on this case, and maybe this is our last subject, our topic, a lot of religious institutions run as body corporates,
Okay.
as registered trustees under the Perpetual Succession Act.
Okay.
So the trusts are one incorporated and unincorporated. For today, the trusts that we are talking of are those of quote unquote the family owned trusts. I'm a Catholic. So the diocese that you hear of is unincorporated
Incorporated trust.
trustees, which have the rights to be sued, to own assets and all that. This other one is just to safeguard the family wealth as such. So there is a difference between that. But both of them have to be registered with the Ministry of Lands and has to get the certificate of registration. The limitations between the incorporated and unincorporated trusts is in the objectives. That's the difference. So the process of engaging a lawyer or a tax advisor to take you through the process of registration is what then need to be understood. Why are you registering this? So as a promoter or a cetra or the creator, you may even, you asked Dan, is it possible to have a trust and a will? You see, a will gives clarity that to the extended, or even people who may not be family people, in the distribution of the wealth. So it's a lengthy process as far as the sharing of that is concerned. But the process of registration starts with coming with the document, the trust deed, setting out the objectives. Once they are understood and they are clear, then you register that with the Ministry of Lands. Then you proceed now to have that will use to transact.
You can transact.
Yes.
It's so interesting. And I think just listening to you, as the guys leading in the financial sector and your expert, you talked about a lengthy process of just setting up. I think it's an opportunity for us to change how we think of wealth and wealth transfer to the next generation, because it normally ends at will.
Yes.
And when you look at will, Dan mentioned it creates fragmentation of a solid company that is split into different shares that doesn't create. You mean 15% capital gain tax due to sales applied on differences on valuation or market price and historic book value? I think this is the one we were discussing earlier. So, Regina, would you like to take that? I have a couple of them. So, as they come,
Into place to bring the asset to sellable use. Yeah. So it is that difference. It is basically gain on the profit.
the gain on the profit,
Gain
basically.
on the profit, yes.
Oh.
The market
value.
price, the market value. So that valuation need to be considered.
Okay.
And it must be done within a certain period of time from when it was inherited.
Okay.
Yes.
Thanks for that. There's another question from Francisca. What is the cost of consulting the bank wealth advisor, and must one hold an account with Equity? First, being a member gives you certain privileges, and even before I hand it over to Dan, one of the aspects that Equity has evolved into, we're no longer just banking you.
Okay.
We've become a financial partner that actually seeks to ensure that you're
We do not charge, but the discussion starts a process whereby we review where you are at, we give our recommendation, but that process currently is free because the bank wants to bring this discussion on your table and you could think about it. So the answer is we do not charge. In fact, once you come in, and we hope you come in and be a member. We start a process that is same to the other members of just establishing where you are at, and then the next steps, you get to discuss with the health specialist. So there's no charge.
Great.
For now.
I think those are the benefits that you enjoy from Equity, where we are pivoting and evolving to be a financial partner beyond just transacting, banking you, giving facilities that you may require. We're evolving you to be able to create generational wealth.
And also to add,
Yeah.
Peter,
Mhm.
Because the bank has built a lot of entrepreneurs who currently are members or not non-members, but at one point they were members. It's also the way of a bank giving back from a knowledge perspective, that we can see we participated in building your wealth, but we are also concerned or anxious that that wealth may stop with you or may end with you. So that's why the bank would choose that path of, we will not charge you for these advisory services, so that we can encourage everyone to think about wealth structuring and wealth transfer.
Great. Another question here. Martin, this one will be for you. Miriam is asking, is it possible to set up a trust at a point where the founder is dead and you're transferring admin rights to another appointed family member?
Well, yes, but it must be guided by possibility of an existing will from the
Founder.
the founder. And there must be what we call probate, the grant of probate. Or the grant of probate is what we call who is to manage these assets as they get transferred to that now trust. So there is a window between which, in the will, there is the list of beneficiaries. And in the will, there is the executor who has been given this to ensure that the wishes of the creator of the will comes to pass and to the beneficiaries. So it is now the decision of the beneficiaries to decide as a family and to remain united. Let's create a trust.
Yes, and just to add on that, for the concerned family, it depends on what stage they are at in succession, because the court must appoint, or they must agree who become the administrator, so that when they go, the probate process is simply the process that you go to court when someone dies and they have assets and they need to come to you or to anyone. So the family must first decide first who is the administrator, because after the court appoints an administrator, the next point is, was there a will? Yes. Is the will contested? No. What did the will say? Transfer the plot A to Peter, the cash in the bank to this person, in a process called a grant confirmation. So the families must decide before the court stamps the documents of the will, whatever the will said. They can ask the court, instead of transferring these properties to Amina, my sister, why does the court give an order that these assets, which you agreed were for individual members, be transferred into a trust which we have already incorporated on the side, so that properties don't move from Ze or Mom to our individual siblings. It moves straight to the trust.
To the trust.
Or they decide, even though Mzee had said the will is this way, we don't want to fragment this wealth. We are going to court asking it to transfer wealth to a trust. And we have all signed on it. So it is possible that even upon demise, whether there's a will or not, depending on the family unity, wealth does not have to go straight to a beneficiary. It can go straight to a trust.
Wow. Miriam, yes, it's possible to establish a trust. in the current situation. But I think the key thing, the learning, and I just listening to everyone today, is start early.
Yes.
Don't wait until I'm nearing my exit plan and to start. And I think as we wrap up, I think for me, I'd like to give you guys to give you a parting shot. And I feel very honored to be amidst you guys in terms of the level of and the depth of knowledge. I know it's been an engaging 1 hour, 30 minutes. I'll start with you, of course, our lady in the room, Regina.
All right, thank you. Thank you, Peter. I'd like to thank our viewers for spending time with us this morning. It's been a very good discussion, and I've also personally learned a lot, and it's triggered some thoughts that I'm sure I'll continue pursuing after this. And I hope that this same effect that it has had on me will even be translated to the listeners that we've had. And to just thank Equity Bank again for this opportunity to engage with our customers, to share the information we have, and to just spark conversations that will help the society. Thank you.
Great. Martin, over to you.
Thank you, Peter. It was great with Dan here and learning more also about wealth management. To our viewers, to our clients, we are still at your service there at CPA Center, Nitram Accountants Africa, ready to serve you. And looking forward that now, maybe to the extent of, as we wrap up this, the remaining bit is now of more of not-for-profit institutions, NGOs, the religious institutions, and the tax compliance. We have just had PBO week. There are regulations that have been issued. So we had the Ministry of Interior, whose docket manages that. And we have so many of your clients at Equity who are not compliant to that. So we look forward to support them to ensure continuity as a going concern. Thank you for the opportunity.
Great.
Okay. First is to appreciate and acknowledge the path that the viewers have taken to build their wealth. It's very hard to, not easy to build wealth in this part of the world, because wealth is built brick by brick. But also, as you build this wealth, I would also encourage you to look at this wealth from a continuity perspective, and start to think of how do we make this wealth becomes resilient or resident within your lineage. This discussion we have had today can be weighty or can draw you out emotionally because you confront the
sad realities.
The continuity of your wealth, if that's your purpose, but also confronts the reality of you not being there to be the steering wheel. But nevertheless, if this world you have built, you want it to pass to the next generation, then you start taking those actions. And I would encourage you, for a further conversation, visit your branch and talk to the branch manager and ask them, you need to engage a wealth advisor from the investment side. And then you have those conversations. It's a step, it's a journey that we are willing to take you through, but we encourage you to think of it. The conversation may have triggered or may have irritated that thinking, but that's the purpose of this discussion, to trigger you to think deeply about not just creating wealth, but then how do you structure it, and then how do you move it. Don't be discouraged or be frightened or be anxious about the legal process. The first question you should always ask is the why. Am I doing this? The how, we have the experts to take care of. Thank you.
Great. Thanks to my panelists. I think for me, I'd like to just appreciate on behalf of our viewers for sharing your insights. And to our viewers for keeping up with us for the last 1 hour, 32 minutes. It's quite been an engaging session. And I think for me, one thing I just want to leave you, and the key takeout for me here is wealth creation is only the beginning. Yeah? Preserving is the real test, and I think we can all attest as to what the realities of life presents us to us today. So without a clear planning and structure of how you want to transfer the wealth, even a strong legacy will fade away. We know of names, but today they are not those names that we used to know. It's history. So I think for us as Equity Bank, we take a challenge, and as Dan has said, we'll continue working with you this journey to be able to help you unpack how do we help you as you create your generation of wealth, how do you help you transfer? And I think as my colleague here, Dan, has said, walk to any Equity branch, just be able to ask for a wealth advisor, and we'll be able to link you us with that. And I think for our viewers as well, please give us feedback as we continue with this series, which will be in 2 weeks' time. We ask you to give us feedback on the poll that's running on the screen. That will enable us to continue making this session better. And lastly, is for me to ask, are we being intentional enough today to protect what we want to pass tomorrow? So I think as we think about that, let's keep thinking about that, and let's have real conversations on the same. With that, I'd really like to thank you all for joining us today. Thank you.
Wow.
Thank you.